Hey guys, welcome to EIKV and this is Vishnu. So in this illustration it is given like the company is planning to repair the machinery or to replace it. So the company have two options, either to repair the old machinery or to purchase the new machinery and replace the old machinery. So for that some of the details are given. Book value of the old machinery is 70,000. The purchase price of the old machinery is 2,10,000. Details of the project manufacturer are also given. Direct labor is 28, indirect labor 14, overhead variable overheads 10.5, a fixed overhead 17.5, and total cost is 70. The products manufactured in the previous year is 10,000. All machinery can be repaired for rupees 10,000 and it has an indefinite future. Cost of the new machinery is 4,20,000 and it can be reduced to 1,05,000 if the old machinery is traded with the seller. So if the old machinery is exchanged with the seller can get you further discount of 1,05,000. The details of the new machinery are under. So if the manufacturer is using the new machinery, then the cost of the project will be direct labor cost as 15, indirect labor 21, overhead variable overhead is 7, fixed overhead is 22.75, and the total cost is 64.75. All machinery can be sold at the market for rupees 50,000, but at any case they won't do that, right? The expected life of the machinery is 10 years, salvage value is 20,000 and tax rate is 50%. Future demand of the product will be stable as 10,000, depreciation is 10%. Okay, then they have given the PV factors. Okay, PV factors for 9 years for 10% is 5.759, which is given in the question, and on PV factor of the 10th year is 0.386. Okay, and they have asked you to get to a solution like whether to replace the old machinery or to repair the same. So at first I have made the computation of net investment. So for the computation of net investment I have taken the cost of the new machinery, which is 4,20,000, less exchange price of the machinery, which is 1,05,000. So after deducting that we will get 3,15,000. After that we need to add the profit on exchange, which means 1,05,000 is the sale price of the old machinery less 70,000 is the book value. So we will get an amount, and when we multiply that amount with 50%, we will get 17,500. So we need to add it back because it is a cost, right? When we sell that product we will get a profit, and for such profit we need to pay income tax. Therefore such amount, the tax amount, is an expense towards us, or a net cash flow, right? Cash outflow towards the company, right? So we need to add that cost. Therefore the total investment cost is 3,32,500. Okay, after that we will compute the net present value. Okay, so here they haven't given any sales price or anything related to sales. Therefore we need to work the cash flow as incremental cost basis. Therefore we need to do this illustration as the incremental cost method. Therefore I have made a table which contains 4 columns: particulars, existing machinery, new machinery, and incremental cost. After that the number of product produced will be 10,000 each, and the variable cost excluding fixed cost will be for existing machinery is 52.5 and new machinery is 42. When we multiply the variable cost with the unit produced, we will get 5,25,000 and 4,20,000 each. And when we take the incremental cost, which means existing minus new machinery, we will get an amount of 1,05,000. Right, after that we have repairs. So we don't have repairs for new machinery, so we 75,000 minus 0 gives 75,000. Okay, after that, which is depreciation. Depreciation can be 70,000 is the book value of the existing machinery, divided by 10 will give 7,000. And for the new machinery we have 4,20,000 is the purchase price, minus 20,000 is the scrap value, divided by 10 years which will give 40,000 each. And when we deduct the incremental cost of depreciation, we will get 7,000 minus 40,000, that is negative 33,000. Okay, so when we take the total incremental savings, we will get for 1,47,000. Okay, after that we need to take the tax amount, which is 50%, 73,500. Therefore we'll get a profit after tax as 73,500,000. We need to add the depreciation, as depreciation is a non-cash expenses, therefore cash will not flow outside the company, therefore we need to add back the depreciation, therefore the cash flow will be 1,06,500. Okay, after computing that we need to compute the terminal cash flow of the project. So for the computation of terminal cash flow of the project, we have the cash inflow as 1,06,500 multiplied by 9 years. The total lifespan of the asset will be 10 years, right? The asset will give a continuous cash inflow of 1,06,500 every year for 9 years, right? Yes, for 10 years, but we will take here as 9 years because there is some adjustment at the 10th year. Therefore, until 9 years we will get a continuous cash inflow of 1,06,500. So the PV factor for 9 years is 5.759. So when we multiply 1,06,500 into 5.759, we will get 6,13,333. And the cash inflow of the 10th year will be the continuous cash inflow of 1,06,500 plus the scrap value of the new machinery, which is 20,000. And when we sum and multiply these figures with 3.86, which is the PV factor of the 10th year, we will get 48,829. When we total the cash inflow, the amount will be 6,62,162. And we need to deduct the cash outflow of rupees 3,32,500. We will get a positive amount of 3,29,662. Therefore, since the MPV is positive, it is better to go for a new machinery. So guys, thanks for watching this video. If you find this video helpful, please subscribe to my channel. Thank you.